Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report from Solaris Energy Infrastructure Inc. It involves convertible notes, which might sound like musical instruments, but trust me, they are financial instruments that can make or break a company's tune. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more in-depth discussions. Solaris Energy Infrastructure Inc. just filed a Form 8K, which is basically a quick update for investors about big changes. In this case, it's about raising a lot of money through something called convertible senior notes and also selling some stock at the same time. It seems complex, but we are here to simplify it. The main event happened on May 1st, 2025. The company made a deal officially known as an underwriting agreement to issue and sell 150 U's to buy shares in the future, and convertible notes as loans that can turn into company stock later on. It is like having a coupon that can be used to buy shares in the future. The company originally planned to sell $135 million in notes, but the people helping them sell these notes, called underwriters, had the option to buy an extra 20 millions. This option was fully used. This is a good sign. It means there was enough interest from investors to purchase more of the notes than initially planned. These notes were offered and sold under something called the Securities Act of 1933, which basically means everything was done legally and registered with the government. The company used a few official documents to make the sale happen, including a registration statement and some prospectus supplements, which are like detailed sales brochures. The underwriting agreement comes with the usual promises and guarantees. Solaris Energy Infrastructure has promised to protect the underwriters from any potential legal problems or losses related to the sale of these notes. It is like saying, if something goes wrong, we will take responsibility. The notes are governed by an indenture, which is just a fancy term for a contract between the company and US Bank Trust Company, who acts as the trustee or caretaker for the note holders. This indenture spells out all the rules and terms of the notes. On May 2, 2025, Solaris actually issued 105 billion of these notes. Remember that the underwriters had an option to buy more. They used that option to buy an additional 20 million. The total amount went up to $155 million. These notes are senior and unsecured. Senior means that if the company goes bankrupt, these notes get paid before some other debts. Unsecured means that the notes are not backed by any specific assets like buildings or equipment. They are based on the company's promise to pay. The notes will earn interest at a rate of 4.75% each year, which is paid twice a year, on May 1st and November 1. So if you owned $1,000 worth of these notes, you would get $47.5 times worth of these notes. You would get 47.5 times. The notes will mature or come due on May 1, 2030. This is when the company has to pay back the principal or the original amount of the loan. Before February 1, 2030, you can only convert these notes into stock if certain things happen, like the company's stock price hitting a certain level. After February 1, 2030, you can convert them whenever you want until just before the maturity date. When you convert the notes, the company can choose to give you cash, shares of their Class A common stock, or a mix of both. This gives the company flexibility in managing its money. The initial conversion rate is 37.8896 shares of Class A common stock for every $1,000 worth of notes. That means each share would cost about 26.39 cents if converted. This conversion rate can change if certain events happen, like the company issuing more stock or splitting its stock. The goal is to protect the value of the notes. If a make-whole fundamental change happens, which is basically a big change in the company, the conversion rate will increase for a while. This is to compensate note holders for the change. The company can choose to redeem or buy back the notes early, but not before May Fund 2028. They can only do this if the stock price is high enough. The redemption price will be the principal amount of the notes, plus any unpaid interest. If the company calls the notes for redemption, it can trigger another increase in the conversion rate if you convert the notes afterward. It gives you a reason to convert your notes instead of waiting for them to be redeemed. If a fundamental change happens, like the company being bought out, you can make the company buy back your notes at the principal amount plus any unpaid interest. The notes have standard rules about what happens if the company messes up, called events of default. These include things like not paying interest or going bankrupt. If the company fails to pay interest, they have 30 days to fix the problem. If an event of default happens, the trustee or a certain percentage of note holders can declare that all the notes are due immediately. The company has the option to pay extra interest if they fail to meet certain reporting requirements. Alongside the notes offering, the company also entered into an underwriting agreement for the sale of some of its Class A common stock. This was done to help certain investors hedge their investments in the notes. This means they can protect themselves from potential losses in the value of the notes. The company offered and sold 1,133,521 shares of Class A common stock in this concurrent Delta offering. Similar to the notes offering, the shares of Class A common stock were offered and sold legally under the Securities Act of 1933 using the company's registration statement on Form S3. The common stock underwriting agreement also includes the usual promises and guarantees. The company has agreed to protect the underwriters against certain liabilities. If you are interested in learning more, you can find the underwriting agreements, indentures, and other related documents filed as exhibits to this report. Now let's take a step back and analyze what all of this means for Solaris Energy Infrastructure. On the positive side, they successfully raised a significant amount of capital, $55 million, which they can use to fund their projects and expand their business. The fact that the underwriters fully exercised their option to purchase additional notes suggests there is strong investor confidence in the company's future. However, there are also potential risks. The convertible notes add to the company's debt, and they will need to generate enough cash flow to cover the interest payments and eventually repay the principal. The conversion feature of the notes could also dilute existing shareholders if a large number of notes are converted into stock. The concurrent Delta placement is a bit complex, but it essentially allows some investors to hedge their bets, which could potentially put downward pressure on the stock price in the short term. Overall, Solaris Energy Infrastructure seems to be taking a calculated risk. They are betting that the capital they raise will enable them to grow their business and generate enough profits to offset the increased debt burden and potential dilution. Alright, that's our breakdown of Solaris Energy Infrastructure's latest filing. What's your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.